Good morning, everybody. Welcome to the Flow Show. It's Tuesday, 13th of August, and another quiet one this morning. It seems like we're really, truly into summer markets at the moment. But there's a few things going on we need to be aware of, so we'll go over those right now. Bloomberg, obviously a bit bored over there because they're throwing up a few headlines trying to stoke the market up. They say that Tokyo has cut its bond issuance plan in a sign of interest rate jitters. This is a story on the government cutting bond sales, so they won't be issuing as much debt. They say it's due to interest rate rising, but I'm not sure if that's them, as I say, just trying to stir things up, because it's not as if the BOJ raising rates hasn't been known for the best part of a year or more that it was going to be happening. So this is probably more to do with maybe the finances themselves, whether they need to borrow as much. But maybe they are just holding back a little bit. You'll know that obviously the BOJ owns over half their bond market already, so that's maybe playing into those talks as well. But anyway, that's apparently the decision they're going to be made over there, and we'll know a bit more about it as time progresses. Again, another clickbaity headline being thrown around that Japan's parliament is to hold a special session at the lower house committee 23rd of August to discuss the BOJ rate hike. Sounds ominous, doesn't it? They have these things all the time. Okay, every 5 minutes they're having a hearing here, a session there. Ueda's in Parliament probably more times than he's in the Bank of Japan, so he's been called up for that anyway. Again, it's not as if the BOJ hiking would have been a big surprise to the government, because they're all in close conversation with each other. They all know what's coming and what's going on. So again, quiet markets might as well stir something up by making a big deal out of this, but these special sessions can happen any time. A bit of data out of Japan, so inflationary data, PPI data coming in as expected, year on year 3%, up from 2.9%. Month on month as well, just up a bit better than expected. So still keeping that inflationary pressure in the pipeline. Over in Australia, we had some wage data, quarterly numbers for Q2, which obviously will be of interest to the RBA. The wage price index year on year coming in unchanged at 4.1%, was expected to dip a bit to 4%, so showing a little bit of stickiness there. On the quarterly number, 0.8% was expected to go up to 0.9%. The prior was revised up, so it looks like a miss, but it's still there or thereabouts. Jobs data from the UK this morning, and a bit of a mixed picture, taking it piece by piece. So firstly, the claimant count. This is for July, so this comes in ahead of everything else. This is all part of the ONS's waffly way they like to do things. Anyway, a big jump in claims, 135k, only just under 15k was expected, so that was the first negative. But then we get the employment change number for June, so the month behind. That was a better 97,000. The unemployment rate dropped, was expected to go up to 4.5, actually dropped to 4.2%. So that's good news. On the wages front, wages came down quite a chunk, including bonus came down to 4.5% from 5.7. Ex-bonus didn't come down as much as expected. Was expected to drop to 4.6%, came in at 5.4, and the prior month got revised up as well. Usual caveats with this UK data and the ONS, it's still a mess. They still don't know how to calculate it all. I don't know what's going on with these clowns, but it is what it is. The numbers are what they are. So for the pound, which has seen a bit of positivity this morning, the market is, I think, largely trading it on the unemployment rate and the employment change rather than the claimant count, and that drop in wages. Those wages still pretty sticky, mind, up around there, and there's a possibility of them going higher as new pay deals for some of the public sector come into play as well. So the market probably looking at this more in terms of soft landing mode rather than what the wages drop means for another rate cut. So for all intents and purposes, the UK jobs market based on the unemployment rate not doing too badly at all. So looking pretty good. And that's probably the positivity in the quid this morning. We've got a bit of final CPI data from Spain, all their CPI numbers coming in bang on expectations, 2.8% in the CPI, 2.9% is expected in the HICP. Move along from there. Germany's ZU, that was a bit of a stinker. Current conditions were expected to come in worse at, if I remember what it was, let me look, expected to come in at minus 74.5, came in much worse at minus 77.3. Even more shocking was the expectations index coming in at 19.2, was expected to drop, but only to 32.6. And a bit of a scathing review from the ZU board themselves, saying the economic outlook for Germany is breaking down. In the current survey, we observed the strongest decline of economic expectations in the past 2 years. So those whatever green shoots may have poked up earlier in the year, they've been stamped all over. It's been rained on, thundered on, lightninged on, and it's now just a muddy bog. So no signs of Germany getting out of the mire right now, just from that index. Over in the US, we've had some no data, but we've had some New York Fed inflation expectations survey. They saw a dip in 1 year expectations, 2.97% from 3.02. I don't know if they show it on here. I'll have a quick look. Don't know what that one is. It might be one of the part of it. Anyway, so that was the 1 year. On the longer term 3 year, inflation expectations dropped to 2.6% from 2.9%, which is the lowest since 2013. So again, that will feed into the Fed's thinking about rate cuts in September. Inflation expectations are a big part of the central bank's thinking. Over in Mexico, we've had the Governor Rodriguez saying that the jump in headline inflation is expected to be short-lived. That was last week's higher print in CPI that we saw. Didn't stop them from cutting rates, though. On the geopolitical stuff, we've had Putin obviously waxing lyrical or spouting out that Russia will respond to this attack by the Ukraine. That incursion or offensive is still ongoing, but we're yet to see what response is going to come from Russia. We've still got this dark cloud hanging over us regarding Israel and Iran, and when this supposed attack is going to happen. We're in the window. Anytime over the next day or two is when everyone's looking at it. The Pentagon has come out to say that they are prepared to respond to any scenario that could threaten Israel's security and our interests by confronting any Iranian-backed proxies. Now, if I load that comment because it says Iranian-backed proxies, that's your Hezbollahs and whatnot, not Iran itself. So the distinction being made clear there. It seems every Tom, Dick and Harry leader in the West, Europe, US, UK, whatever, has been on to the Iranian leaders to try and tell them to show some restraint. Iran's basically told them to fuck off, and they're going to do their own thing. So still we're in this situation where it could go one of two ways. We're going to get another show of strength without really seeing any damage, like we saw back in April when they lobbed hundreds if not thousands of drones and whatnot over Israel, most of which got shot down. The rest were targeting low inhabited areas, shall we say. So it was a bit more for show, but obviously we hope that's the case this time if anything happens and it's not something more concerning. but the risk is there that it is. So that's why we still need to be careful about trades. Another story just popped up concerning one of the big FX platforms, interbank platform EBS. It's seeing its market share of liquidity dropping. And this is more a case of people like banks. What they're currently doing is they're building their own platforms, and more so creating a market or offering liquidity direct to customers. So they're matching off customers' orders against each other. So why is this important for us? It doesn't change the daily liquidity or daily transactions that go through, but what it means is that if people are opening up their own platforms to their own customers, they're taking the pool of liquidity out of the EBS system, the interbank market system, and they're putting it in their own backyard. So transactional wise, we're not likely to see a difference, but now we're seeing the pool of liquidity split into different pockets. Okay, so now if you're only trading liquidity with your own bank, you're not accessing the wider liquidity pool. You're only pretty much accessing the liquidity your bank is offering. The ramifications of that I'm not too sure about, but it could be that it does create these volatile pockets like we've been seeing, where the machines are taking over and there's not as much liquidity in the main pot or other pots to deal with any volatile times like we saw last week. Now, a lot of these banks will still be plugged into the main liquidity, but as I say, it's just on a first glance and taking a look. As I say, it's more a case of the pot of liquidity is being put into different pools, shall we say, and don't know exactly what ramifications are going to come from that. Yeah, it's all Patrick. It's all to do with fees, profit. Why put everything into the market when you can create the market yourself and take advantage of that? Let's see what happens when next time there's a crash. Right, that's it from the headline stuff. Not a lot going on today at all. As I say, really into summer markets. But we got some data coming up later on from the US. We've got the PPI data dropping, which is going to be our first insight into the July's inflationary picture in the US, with the CPI coming tomorrow. So a lot of eyes are going to be on this, because usually we get the PPI after the CPI, but this time it's the other way around. So the market may try to draw some conclusions from this number, extrapolate it over to the CPI tomorrow. As always, PPI is can be a far more volatile number. So you can see bigger swings in PPI than you often do in CPI. So expect to maybe see some wild numbers, but it may not be as explosive as the number says. Okay, if core PPI goes to 3%, that looks big, but it's not CPI. Okay, so it can have, as I say, a bit more volatility in that. And we got Bostic speaking a bit later. So we get another Fed head waffling about what the latest is with monetary policy. Right, that's it from the headlines and whatnot. Mark, I'll answer that question in a moment, mate. I'll just have a quick look around. As far as your DAX question is concerned, yes, the data is important, but if you're taking just the fundamentals, you've got to ask why the DAX is up here at all, let alone why the DAX isn't trading down at 10 grand based on the fundamentals. It just shows you that stocks are still detached from reality in certain aspects. So that's why you're seeing the DAX following pretty much every other stock market as well. Also think about the makeup of the DAX, the companies involved. Some of the, just like the UK, the smaller UK centric or country centric indices may be showing a different picture rather than the main headline indexes. Right, so what is going on? Well, the pound as mentioned, start with cable. That's having a go at this 128 level. That was my big level. We've been added to with the fib of this move from mid-July. So I don't usually like such short-term fibs, but while markets are quieting down a bit, I decided to lob it in. So that's coming in round the 128 level I've been banging on about. The 50 fib coming in around the 128.50 level I've been banging on about. So really it's more just a bit of confluence of the tech involved here in these levels. The data took us up above 128. We ran into the fib. We've had a little dip under. We're back above. I did write this in the chat room this morning. Unless we see a hold above 128, 128.10, we're probably just going to see the price waffling around. Okay, we need to see some proper support built on the break here if it breaks. Otherwise, we still remain in this range, this traffic area down here. Still a chance that we might even head back low towards 127. So we're in midair over this hurdle, not quite clearing it just yet before moving on to the next one. Euro sterling's obviously got my interest because I'm short this one still. I did take a little bit off first thing this morning. We woke up at 85.40. We're just trying to decide what we want to do at this 30 level, which is my next level on the chart. It's not a big level. It's just a level that we've seen a bit of prior action around. It's not even really that clear, but you got to stick your line somewhere. So my line's in at 85. What is it? 35, sorry. So again, just trying to mooch around here. We have maybe made 85.70 resistance again. We had a little pokey up on Friday. We couldn't get above there yesterday. Whether we've actually resolved a break of this 55 or this 50 level remains to be seen. I'll keep an eye on these three lows that we poked below it. So the level is probably 45.50. We're talking really 10, 15 pips between levels here at the moment. So if we get a bounce from here, then I'd expect traffic to run into here back above 85.50. This just looks like a little bit of a fake out, and then we'll see what we want to do. But it's going to be a slow thing, I think. If we do get and stay below this 30.35, then we're going to be, again, another 10, 15 pips. We're running into traffic at 85.15.20. So that's the next area I'll potentially be looking to get out some of my shorts. Slice and dicer is on. I've already brought my stop down. I was short 85.96, 86.13. So I cut all the rest of my sub 86 shorts in this move, and now my stop is 85.90, protecting the rest. If we get below here, then I'll pull the stops down with a bit more gusto. Really, 85 is where I'd like it to go to. If we get there, I'd really pull my stops down, take a bit off, and then just see what we want to do at the big figure. If we're going to hold it and maybe start playing an 85.86 range. So that can come into your question, Mark. When you enter a trade, do you use a buy stop, sell stop, or do you mainly use market in execution? Well, depends what trade it is, Mark. If I'm just entering, I'll just use limit orders. If I'm doing break trades, then I use buy stop, sell stops. So for example, if I thought that we were might be looking to break this 86.20 area, let's say I was flat and I wanted to get long, I don't want to really buy it up here at the top. I'd rather stick a buy stop, say 86.25.30, because if likelihood is if we're trading there, we're looking to break, so I'll look to catch a reaction, get long after the break rather than try and guess the break, because if it doesn't break, then nothing done. I'm not in a trade. I've got no risk on the table. So buy stop and sell stop orders, I say, I use for break trading because you place them outside of the market or outside of the levels rather than inside. So if I was looking to buy, I'd have a limit order. If I was looking to sell, I'd have a limit order or an offer, bid and offer. Okay, so my buy stops and sell stops are for personally for me, break trading or reversing a trade too. The same way I'm short here. If we break, my stop could be a reverse into a long to try and catch the break. Dereg gold, yes sir. Let's have a look at gold. I was looking at, again, I wrote in the chat room this morning, I was looking at this one last night because we were creeping up 60, 65. And I was thinking, if it wasn't for what was going on, if it wasn't that these risk events were driving the price, I'd be probably tempted to have a little short up here into this area, which we know 2480 has proven very sticky, and thus it's proven sticky again. But do I want to put on a short, go to bed and wake up to Iran kicking off and we're trading 25.20 and my stop has been blown out, gapped higher, whatever, I've got a worse price? It's purely a risk reward thing for me right now trading this. I would love to trade it short, but I'm not going to trade it short with this big risk cloud hanging over. As I said, a big headline, we could be 30, 50 bucks higher just on that event, like we saw previously when we had these spike moves here coming around on different events. So yeah, I'd like to short it here, but I'm not, because I don't see it as decent risk reward. You know, yes, it's come off 10, 11 pips from these highs here, but what am I risking? I'm risking 30, 50 pips on a potential gap stop versus 15 pips of profit. These are the times where, even though I'd like the trade, I don't like the condition. So I've got to be a risk manager more than a trader. But what I will be looking for, if we do, let's hope we don't, obviously, get any dangerous headlines. But if we do, I'll have to assess those headlines. Is it another Iranian move for show, or is it something more significant? If it's for show, we'll get a pop. I'll look to maybe hit that one, or wait for another move to fade and go back under the level, just like we saw here. You know, we had this big level, 2400. We got a headline, blasted it through, back under. As soon as we're back under, it reaffirms itself and becomes a level again. Another risk move. As soon as afterwards, we're back under again. So I don't need to try and catch this. Okay, there's always an element of trying to catch a headline. I don't need to catch this. I can perfectly well try and capture the price moves afterwards for the same objective. Now, if you're long gold at the moment, then you're sitting pretty. If you do get a big headline, then, you know, don't hang around. Don't think, oh, right, it's spiked 50 pips, it's going to go another 200. You know, you don't get 50 pips in a blink of an eye very often in trading. Take some profit off the table in any move like that. Bring your stop up, protect the rest, then see what it wants to do. Okay, so don't look that gift horse in the mouth if you're on that side of the trade as well. Mark, why do people trade silver versus gold? If you mean the ratio, I don't even know if it's if you can actually trade it unless you actually, you know, short one, long the other as a sort of spread trade. I don't know, is the honest answer. Mark, I don't look at the ratio, gold silver ratio. I know Dale looks at it. It gives him clues and signals. It's not something I look at. I have enough wine about trading an asset on its own merits, let alone the ratio of another. But yeah, I'll if I remember, I'll bring that up with Coach on F.A.C.E later on. Philip, yeah, I was going to jump to oil. No real change to the sentiment here. This is all looking risk-based at the moment. We have had some OPEC plus headlines talking about production, not looking like any big changes can be made there. So on that side of things, it looks like business as usual. But again, we're just trading these risk headlines. So this is another asset where we know it's weak on the back of the fundamentals, because we know manufacturing is generally crap around the globe. We saw that from the ISM last week. So purely on a fundamental basis, and the fact, take countries like US, they're still pumping you know, higher and higher amounts. There is no fundamental reason why oil should be shooting higher. So if this is only going higher for risk, if risk dissipates, then we're probably going to come all the way back down again. But again, it's a risk reward trade. Where do you want to short it? you want to short it here ahead of the headline? Do you want to wait for the headline and short it up here? I'd rather lean on some of my levels higher up, and again, judge any risk headline on its merits at the time before deciding a trade. So I wouldn't buy it here. I wouldn't sell it here. I'd wait till now. I'd wait for the headlines to drop. What else? Let's have a look at yields, which are probably not doing an awful lot. No, 10-year yields still easing off a little bit from that 4% mark, as mentioned. We're probably just going to do a little bit of sideways action. The data might get us moving a little bit, PPI, CPI, but otherwise I can see us going sideways because the market will start to put its focus on Jackson's Hole next week, when we'll get to hear from Powell and whatnot. Hopefully, which will either give us some clarities or some mud to look through. Really, I don't know where else to go. Come on, help me out, guys and girls. There's not an awful lot going on. Really isn't. Dollar CAD, let's have a look at that. So again, I've been saying this, we're not seeing the CAD continuing to gain on the back of the oil price moving up. So as I mentioned, it's a time when your correlation, where the fundamentals of one asset override the fundamentals or the moves in another asset. So we're not seeing the CAD gaining anymore. The market is happy to keep dollar CAD around this 137.20s area, 30s area. So it's going to take something else, either from the US data or something out of Canada, to get this moving. Now, obviously, if we get a big spike in oil, then maybe we'll see the CAD gaining. But again, I'm not too sure how risk markets are going to trade it. Does it mean dollar strength on the risk basis? Does it mean CAD strength on the oil price basis? So I'm not sure what to do with dollar CAD when looking at it from an oil perspective. So in that light, I'll look at it from its own perspective. You know, my levels, we're bang in the middle of the range, 136, 138, 139. No interest in the middle here. Marky Mark and your US stocks. You love these US stocks. Love these US stocks. Now, what we have seen is the Nikkei continuing to unwind the moves down. So again, we're probably doing a lot of following in other stocks, at least over Asia, European sessions. So the Nikkei really clawing it back right now. Where can it go? Who knows? It's not a chart I have any tech on, as you can see there, but you know, I'll be looking at maybe 37s, high 36s, 37s, which looks a bit of a breakdown point. So that's one area I'll be looking at to see if we run into trouble or if we get back above it. So as just mentioned, we're seeing, you know, similar moves in a lot of these stock markets at the moment. So can S&P, chances it could break higher? Yeah, of course it could break higher, but it's got a big hurdle to come into. 53.90, 54, as I've been banging on about. What we are doing still is holding support down at this little area here, so it's got a platform to build on. We're keeping this uptrend going. So here's the number, 54. Can it break higher? Of course it can. What it can do is not what we should be concerned with. What are you going to do with it if it doesn't? Again, this could be talking about buy stop, sell stops. If you're long, this is a level you want to think about taking some profit off at in case we don't get through it. If you want to go short, this is a level to do it against. You can keep a tight stop. If you're not long and want to get long, you're not getting a dip, then you can use it as a break point. Stick a buy stop in, you know, 54.05, 54.10, something like that, whatever you decide to do, and try a long attempt if it breaks. Or you wait for it to break, wait for a retest and see if that retest holds. Then that will give you conviction to try along in that scenario. But you know, when you've got levels like this where a big decision has to be made, you don't need to risk a lot. You know, if you trade a break, then, you know, a stop below 53.85, 80, something like that, quite tight, will probably do you well. So many ways to trade it. Can it go up? Of course it can. Also go back down again, just as equally. No, don't use RSI. Don't use MACD either, Mark. the market's only overbought and oversold when people stop buying it and stop selling it. And no mathematical number is going to tell me otherwise. Hitting that level and not going further tells me we're going to be overbought. Okay, so again, nope, you never see MACD or RSI on my charts, mate. What else shall we look at? Let's have a quick look at copper. Just again, this is a bit more of a risk trade still. So we've had a little bit of a pickup, but we're still remaining in this downtrend. So again, this is just one just to keep in the back of your mind on a corner of your PC, just to keep an eye in terms of risk. And because again, if the fundamentals kick in, then we're probably heading back down to the lows on that. Right, I'm going to call it a day, folks. I could go through 100 different pairs, but might as well save some time for something coming up tomorrow. We'll call that a day. One more day from me, and then you've got Stelios coming up Thursday, Friday, because I'm off for another short break until next Tuesday. So Stelios will keep you in good company there. Make sure you have loads of questions for him. Loads of questions. Ask him about Mark. Ask him about RSI, MACD, and all the rest of it. Really badger him. I'm going to tell him. I'm going to say it's all going to be nice and calm, but I want you to get thinking. Get your thinking caps on and give him loads of questions. Anyway, enough. Have a great day, everybody. Trade safe. We'll see you tomorrow.